Canadian economic output edged up 1% at an annual rate in the fourth quarter. The growth mainly due to higher exports of oil. What does it mean for the Bank of Canada's interest rate policy? We're joined by Avery Shenfeld, Managing Director and Chief Economist at CIBC Capital Markets. Avery, great to see you. You've been looking into this number, and the details, you say, include pretty weak domestic demand.
Yes, so domestic demand actually fell. As you mentioned, it really was the strength in exports that drove growth. And really, this is a story that if you look back over the last year and a half, we've had the occasional little quarter that looked a little brighter. But I think the bigger picture perspective here is that growth over the last year and a half has been quite anemic. And if you take population growth into account, essentially the economy is still declining on a per capita basis. So better than, I guess, an outright recession, but not particularly good.
Do you think we should change the model and start reporting per capita GDP and other indicators, Avery?
Well, people are focusing in on that number because, of course, GDP per capita really tells you how much money there is to divide up among Canadians, and is really what drives standard of living gains. So if we bring in a lot of students who work part-time and temporary foreign workers who get paid relatively low rates of pay in generally lower productivity jobs, that's not really helping create wealth and living standard gains in Canada. But remember that a lot of this is just the economic pain we felt we had to go through to get inflation down. And the real drag is showing up, in fact, in those interest-sensitive sectors. So businesses aren't borrowing for capital projects and buying equipment, and Canadians aren't borrowing to buy or build houses. So the slowing is intended, and it's intended to get inflation down.
You say that the savings rate, something like 6.2%, remains well above the pre-pandemic level. Is that sort of a long-term shift, do you think?
I think that's just a symptom of high interest rates. So what high interest rates are supposed to do is tell Canadians, don't borrow and spend more than you earn. And that raises the savings rate. And also, you're more tempted now to put money away, earn 5%, and spend it later after you've had some interest on that money. So actually, the US has been the real outlier here. In most other countries, high interest rates are resulting in savings rates today that are higher than they were, say, for example, prior to the pandemic when interest rates are lower. The US is the only country where Americans seem to be happy to borrow more and spend more. But even there, I think there's a limit to how long that will last.
American exceptionalism. You said, on a kind of sober note there, you said businesses are not borrowing to invest in Canada?
No, they're not. I mean, capital spending has been a weak spot, and it was quite weak in the fourth quarter. There are some exceptions here, but generally speaking, when you raise interest rates as a central bank, you're really trying to slow interest-sensitive spending. So this is a case where, to some extent, we should be happy about the bad news because we needed to have a dose of a slowdown to open up a bit of economic slack to get inflation down. The inflation numbers are moderating. So at some point, in the second half of the year, when we have lower interest rates, I think we'll see a bit of a revitalization, not only in the housing sector in Canada, but perhaps business investment as well. But now is not the time, obviously, when people want to borrow a lot. And the same is true for businesses.
Consumers notoriously feel miserable, even when the economy is not doing that badly. So our economy, it's not sliding, but it's kind of trundling along, it sounds like.
That's right. It's hovering on the brink of bad, but not good. And it's not every consumer that would be pulling back. There are lots of people who have no debt, paid off their house, not really feeling the impact of higher interest rates, and are still out there spending. But remember, we also have Canadians whose mortgages are coming due, or who have a mortgage coming due in 2024, 25, who are starting to perhaps decide to be a little more careful about what they're spending because they know that their monthly payments on interest are going up in the next year or two. So I think that's what we're seeing here. We're just seeing a bit of caution, not panic among consumers. And that's why the economy has been quite a bit slower here than in the US, where Americans locked in 30-year mortgages back in 2020 at very low rates.
Are they ever happy about that? It's really a difference, such a fundamental difference in their market. To do, I gather, with government support for the mortgage sector in America. So we have avoided a technical recession, which some other group of 7 nations have fallen into.
Yes, that's right. And we were not among the economists who were forecasting a recession last year. And we're continuing to forecast some small growth over the balance of 2024, in part because we don't think a recession is necessary to get inflation down to 2%. It is melting away. It's falling in the US, where we really haven't seen much of a slowdown at all. And that's actually the best news. It's a sign that, yes, we needed a slowdown. Maybe we'll have a bit more of an upturn in the unemployment rate as part of that. But a full-blown recession would probably be more medicine than we need to get inflation to 2%. And we have heard the Bank of Canada governor say that he doesn't believe that we'll need a recession to get to 2% inflation, which is encouraging because that does mean that, or suggests that he's prepared to cut interest rates if it looked like we were falling into one.
Is there a risk, though, that he'll just decide on the side of that awful phrase, an abundance of caution, that we might keep off from holding rates right into the fall, or would that be too drastic?
I think he recognizes that you have to, given the lags in monetary policy, get a little bit ahead of a further slowdown, get ahead of the big mortgage renewals that are coming up in 2025. And the Bank of Canada's own forecast called a pickup in growth in the second half of the year. And they explain that in their policy report by the impact of easier financial conditions. So presumably their forecast is also counting on their own interest rate cuts as part of what keeps us out of an outright recession.